Let me ask you one question first. You've got $10,000. Alphabet is at 321. Will you buy it now or do you wait? If you can't answer that question instantly, let me give you a framework that takes 3 minutes. No fluff, just logic, and you'll have your own decision. Welcome back, I'm Grant and I blew up a $650,000 account in 2022 and rebuilt myself from zero. So I don't waste time on theory. Let's cut straight to what matters. Every stock decision comes down to 3 questions. Question 1, is the business getting stronger? Question 2, is the price reasonable? And question 3, what's Alphabet's hidden edge? That's it. When you have the answers to these 3 questions, you'll know what to do. Let's go through them for Alphabet. Question 1, is the business getting stronger? Look at the trend and not the headline. In 2024, Alphabet brought in $350 billion in revenue. That's up 14% from the year before. Net income hit $100 billion, a huge jump of 36%. And cloud still growing strong, around 28 to 34% each quarter. And that's not random, that's real momentum. As for margins, cloud used to burn cash, but not anymore. Back in 2023, cloud margin was just 5%. Last year it jumped to 12%, and now in 2025, it's heading towards 17 to 18%. Every new dollar now actually adds to profit. So what's my take? Yes, the business is getting stronger. Not maybe someday, this is actually happening right now. Question 2, is the price reasonable? Here's where most people overthink it. Forget the 50-page DCF models, just use simple math. So let's run the 3-number check. 1, PE ratio. Alphabet's PE is around 32, slightly above its 10-year average of 28. A bit pricey, yes, but cloud margins today are roughly 3 times higher than in 2020, so the premium does make sense. 2, PEG ratio. Right now it looks over 2, which usually signals expensive, but that assumes cloud stays at its current share of revenue. If cloud grows to 20% of total revenue, the PEG drops below 2, much more reasonable. 3, comparison test. Microsoft trades at PE 34 with faster cloud growth. Amazon trades at 38. And an Alphabet, well, its cloud is growing 30 to 35%, yet the PE is lower, which makes it look pretty attractive. So basically, you're getting almost the same growth, but paying less for it. So in conclusion, it's not exactly cheap, but it's not expensive either. It's actually fairly valued with real upside if cloud keeps growing. Question 3, what are Alphabet's hidden edges? And this is the big one. Most retail investors skip this step, but it's actually the most important. Here's the simple idea. What advantages does Alphabet have that the market hasn't fully priced in yet? Well, right now, Alphabet has 2 clear edges. Hidden edge number 1, the TPU wildcard. Alphabet is selling custom AI chips to Meta and a few other hyperscalers, and the market hasn't even priced it in yet because these deals aren't officially in revenue, they're still in partnership talks. But when that first deal finally drops, well, the stock could easily jump 8 to 12% in a single day. Now that's the power of being early. Hidden edge 2, margin expansion. Now everyone obsesses over revenue growth, but the real magic is what's happening with margins. In 2023, Alphabet's operating margin was 27%. Now in 2024, it jumped to 31. And this year, in 2025, it's already above 33%. Now if margins hit 35% by 2026, EPS could rise 15 to 20%, even if that revenue stays flat. So the real edge here is betting on these 2 things, TPU monetization and faster margin growth before Wall Street fully prices them in. So what could you do at $321? Well, if you don't own any shares, don't go all in at this price. Start small, maybe 1/4 of your target position, just to get some skin in the game. Then add another chunk if it pulls back to 290 to 310, and another piece if it drops to 270 to 285, and save a little bit for a breakout above 340, riding momentum. Why staged entries though? Because of PE at 31.7, there is no safety net. One bad earnings report could wipe 10 to 15% off the stock in a single day. Staggering that protects you from it. Now, if you already own shares, my advice is simple, hold. Don't panic sell, but I also wouldn't add more at 321. You need to wait for either a pullback to 290, a good spot to add about 20%, or a confirmed breakout above 350, add maybe 10% more. If you're trading short term, here's what to watch. Support levels, 310, 290, 270. Resistance levels, 330, 345 and 365. RSI neutral at 47.9 and MACD slight sell signal. We're not overbought, not oversold. These support zones are interesting for swing trades. And here's the one thing you really need to remember. Price matters more than the story. Alphabet's story is amazing, no doubt, but at a PE of 31.7, you're not getting a discount, you are paying for perfection. So my advice, stay small, build smart, and stay patient. In the next episode, we'll dive into TPU versus NVIDIA versus AWS Inversia and see who wins where. Don't forget to subscribe and turn on notifications and hit like and save if you think this is useful. I'm Grant and I'll see you guys next time.